Ladies and gentlemen, welcome to the third episode of Living Markets with Liberty here on EBNet Stream. Today I'm joined by the trusty old John Taylor, actually at Liberty Corporate Benefits, who's going to be updating his views on the markets for us. And then we decided to spice up our relationship a little bit I'm going to try to get this right now. I've been practicing it all night. Okay. Ndivhuho Netshitenzhe. That was a terrible attempt at that. But Indy is a senior economist at Stanlib. So we just chose to invite her, given that we just had the budget speech this last week, to get some input from a professional in this regard, rather than just listen to John and myself. So Indy, first of all, to you, welcome and thanks for joining us.
Thanks for having me, Leon. It's really, really fun to be here today.
Excellent. It should be fun indeed.
Yeah.
John, we talk about, well, welcome, first of all.
Thanks, Leon.
But we talk about the markets every single month, and they keep on going up.
Yep.
And it's bothering me. It's defying gravity. I think year to date, it's, what is it year to date now? The JSE is up.
Over 20, yeah.
A year to date, 9.4.
Yeah.
1 year, 49.1%. This month, 5.4. I mean, come on.
Yeah.
It's just not realistic.
You see? Yes. So I was thinking about those predictions that we put up at the beginning of the year around where the year would end. And actually, all of my metrics are largely correct as of today. But the problem is there's still another 10 months to go, So if the year could end now, I know that I'd be right. So, with the JSE's all shares sitting at kind of just under 130,000, you got the Rand that continues to hold steady at stronger than 16 Rand a dollar. The gold price remains extremely high. I mean, it's, let me just get the latest number here, $5,100, nearly $5,200. It's crazy numbers. And I guess your point is valid. We've seen it creep up again through the course of February. And one does have to ask, when does this thing get a little bit heady? But at the same time, you can't ignore the fundamentals. Interest rates remain, positive outlook there. Inflation numbers scary in some parts, but not too scary. We've just come through a phenomenal budget, but I won't take away from what Indy is going to share.
So I wanted to actually raise that. Are the fundamentals keeping up? So yes, the big macro numbers are looking good, but are the earnings ultimately coming through? And you said, you just used the term a phenomenal budget. I don't know if those were the words you used. Mm-hmm. I thought it was a positive budget, but a bit boring, if I could put it that way. To me, it was like the things I wanted to hear about. I wasn't really hearing some of the really critical things. So without going into my opinion on it, because I'm by no means an expert when it comes to that, Indy, can you please enlighten us? How did you see the budget? What do you think are the key aspects that are positive? And how do you think this is ultimately going to end up impacting the big picture? And the big picture things like unemployment, inequality, infrastructure development, and ultimately maintaining these incredible returns we're getting off the JSE.
Oh, of course. Let me just share my slides. I wouldn't be an economist if I didn't have a couple of slides to show you guys. Like you said, the budget this year was a little boring, especially when you come off last year where we had 3 budgets in a space of like 3 months. So this year we're more than happy to have something a little less exciting. The minister presented his 5th budget this week. Some people might say it's his actual like 7th, but 5th is the official number. And this time, I think, as you're probably all aware, there were no disputes between the GNU partners. So there wasn't really any political fallout as a consequence of this year's budget, which is definitely good news. With that said, many people are asking, and a lot of discussion has been happening on what did the budget really present? It's a little boring in that there wasn't a lot to take out of it, but what was there that we can actually take out, that we can eke out from the information that came out? And the simple answer, and it's probably the most important thing, I think there was no big shock announcements, which is welcome. But more importantly, the budget offered a continuation of fiscal discipline. Fiscal consolidation has been a theme with this administration for many years now, and it's finally now that we're seeing with this budget that there are concrete proof points to this, which means we can finally start believing the story that the minister has been trying to sell us, that government is serious about putting government's fiscal position in a much better shape, maybe use some of that the base that we're getting to really grow the economy, get things going this time around and improve the growth outlook and the consequences of the budget, which I will discuss a little later, starting to show some improvement in the base outlook for South Africa's economic growth, which hopefully would lead to better employment outcomes and better sort of income growth for consumers and households. For now, though, I want to focus on some of the tangible proof points that I was talking about a little earlier. So that kind of further confirm government's commitment to fiscal discipline. Right now, I think, come up with 4 proof points. The first is the minister further reducing the budget deficit. The extent that the government, so basically what the budget deficit is the extent that the government spends more than what it collects. So if you look at it as a percentage of GDP, it came out at minus 4.5%. Last year. And if you look ahead, the minister is projecting that this will improve over the medium term. And it's really going to drop to minus 4% next year and then be below 4% by 2028, 2029. Now, next year's minus 4% isn't really ideal, right? Usually you'd want something to be around 3%, which is something we'll see more further out into the medium term, but it's definitely a move in the right direction. And especially given the fact that not too long ago, South Africa's deficit was sitting almost at 10%, right? And 5% was a normal, or minus 5% to GDP was a normal outlook for South Africa. So this is definitely a more tangible proof point that things are moving in the right direction. Secondly, the reason why the deficit has been able to actually move in the right direction is because of this sort of primary budget balance that has been positive for a number of years now. Now, the primary balance is calculated as you take the budget deficit less the interest costs that government pays, and then you get the budget surplus, which measured at 0.9% last year of GDP. And the minister has said that the surplus is really going to continue to rise, increasing to 1.6% next year and increase even further in the outer years. Now, this is a meaningful increase if you look at the medium-term outlook. And there's going to be commitment, I think, to maintaining this budget surplus because we've already seen that they've been able to have a budget surplus for the last 3 years. And Treasury is saying that government will continue to seek to spend less than what it is earning. And that's definitely a huge relief for sort of people who are looking at fiscal outlook for government.
So now, if you don't mind, can I just come in there? Because I like everything that you're saying and I agree. And I can see that there is a fiscal discipline mindset that's coming through. And particularly from Minister Godongwana, however you pronounce that, I'm also struggling there. But he's a free market thinker. The rest of the parties doesn't always see things, I think, in that light. And the civil wage bill as a percentage of GDP, I believe, is the biggest in the world or the highest in the world. So is this not a bit, it's good, but it could be so much better?
I mean,
there's not enough action being taken.
Definitely, it's definitely good. If you speaking on sort of the wage bill discussion, without a doubt, South Africa's wage bill is definitely one of the largest, public wage bill that is, one of the largest in the world. And we have seen government try to tackle this over the years. They definitely do face a lot of pushback coming in from the trade unions. We've seen the multi-year wage settlements settle at a much higher rate than inflation, and definitely much higher than what government would be comfortable with in trying to control the wage bill. However, if you look at the recent numbers, we are seeing a slower growth in the compensation of employees, which is generally the wage bill. I think for the next 3 years, government has projected that the wage will grow by around 4.4%. Now, granted, that is definitely above the inflation expectations of government, which is sitting around 3.3%, and definitely above this new inflation target that the SARB has come out with. but it's a move in the right direction. It's a move where earlier in like the last couple of years would have never seen the wage bill growing below 5%. So we are seeing movements, and it's definitely a tough move. It's definitely a tough, I guess, job for the National Treasury to try and get departments to not only grow the employee numbers less, but also try to reduce the number or the amount that you increase their wages every single year, coming out of many, many years where the one thing you're certain of is that government employees will get a very good increase every single year. So the work is being done. It's definitely very slow, but it's definitely getting there. And you've seen, I think there are two, if you looked at the budget, there were two areas where government, or at least the National Treasury, was trying to find additional ways to control the wage bill. The one was looking at ghost workers. So the work started last year where they're trying to identify some ghost workers where people are earning salaries but don't actually work, or they're earning more than one salary from different departments, but obviously they can't be working in multiple departments at the same time. The National Treasury was able to identify, I think, over 4,000 ghost workers that are seen as high risk. Further investigation obviously needs to take place to try and see what is the issue around this. But finding out that you have 4,000 workers who are ghost workers is a step in the right direction to try and eliminate those, suspend those workers, and try and recoup that money somehow. That's the one area where they're being reasonably successful, I'd say. And then the second area is the early retirement program that they implemented last year also. So trying to get people who are over 60 years old, but not quite at 65, to take early retirement. That has also been reasonably successful. I think they had expected to get more people to take this up. So far, I think if you look at the budget numbers, they are saving around 2.5 billion in people taking this up. They'd expected to save around 7 billion a year, but they'll take whatever they can. And this, again, is a step in the right direction. Definitely more needs to be done, but we need to give credit where credit is due in that they are taking the right steps and not seeing the opposite taking place, where we're getting the wage growth sort of ramping up again following the multi-year wage agreement.
So I respect that and I understand why you say that. I must say, I still feel that it's just too little. It's too little, too late. And I think a lot of it is driven by the politics and factions and maintaining control and so on. Yet the average voter, and that's going to tell in the polls when we get to the municipal elections, they're saying, this is bloated. There's just too much there. And it's not a case of tightening your belt. It's about cutting out. And investing in other places. But I'm not going to put you on the spot in terms of that. I mean, you've answered the question. I'm just expressing that to me was my biggest disappointment when I listened to the budget.
It's a fair observation, I think. And a lot of people, me myself included, would have preferred a more tougher stance taken by the National Treasury. But given the laws that we have, especially labor laws, and given the history that we have around trade unions, it's hard to take that tough stance in an environment like South Africa.
Fair enough. Okay, sorry, Karen.
Okay, so I guess moving, one back. This is the third area of discipline that I think we have seen around the budget. If you look at our debt to GDP profile, now the minister has been talking about trying to get debt to GDP levels to peak and finally start moving lower. And I think this year, or at least last year, which is 2025, 2026, they're finally going to achieve that. Granted, the peak is ending up a bit higher than they initially anticipated. So instead of peaking at what they thought in the medium-term budget to be 77.9%, now the peak is almost 1 percentage point higher at 78.9% of GDP last year. Now, the reason for this is twofold. Firstly, the nominal GDP, which is the denominator of this parameter, is weaker. And that is really because of the lower inflation. So if you have a lower inflation, it means that your GDP, by, I guess, mathematics, will be lower. And it's a good thing to keep inflation low, but there's also some unintended consequences, and this is one of them. The second reason, though, is that the National Treasury decided to take advantage of the strong investor demand in domestic and global markets by increasing borrowing in 2025, 2026 at a more favorable rates. So the market was looking good, and it seemed like they can get some of that sort of front load some of the debt they wanted to issue into this year to take advantage of the positive markets that we've seen coming out of not only in South Africa, but also globally. So that kind of puts us in a better position going into this year, meaning that you won't need to borrow as much. And given that nobody really knows what's going to happen to the market going forward, especially with the large amount of political, I guess, uncertainty, anything can really happen to the rates. And so taking advantage of it last year was probably a good move for the National Treasury. Now, regardless of the reasons as to why the debt to GDP profile is peaking at a higher level, it's reasonably unacceptable that it's so high. I mean, almost reaching 80% of South Africa's debt levels and debt to GDP, that is. And this is especially concerning because how sluggish growth has been for the better part of 15 years, even though debt has been accumulating for so long. So what it means is that the economy or the government has been increasing its debt levels, but this hasn't actually been productive. There hasn't been done to grow the economy. It hasn't been done to reduce poverty. It hasn't really even been done to try and address unemployment or inequality. So it's been really ineffective and unproductive accumulation of debt to such high levels. But on the positive side, I guess, from here on out, debt is expected to moderate. And this time, unlike previous years where every 2 years, the minister would say debt would moderate after the peak, debt would moderate after the peak in 2 years. This is actually seeming quite tangible. And it seems like debt to GDP will fall to around 77.3% this year, which is a meaningful drop from the 78.9%. And going forward, we're going to see further drops in this. Hopefully, by the time we reach 2033, we're going to see our debt levels below 70%. And I think well, the National Treasury at least is doing a lot to try and get that to be a reality.
And yeah, this side, I like that slide. If you can just go back to that, there's a particularly important point. It reminds me of the journey of a particular football club called Arsenal. As they're coming up through the ranks, they're doing well, they sort of outperforming where they thought they would be. The Man Cities of the world are slightly lagging, and then it mean reverts as Arsenal chokes and they lose the league after a lot of hype. So I just thought I'd throw that in there because it's reminding me of that. So apologies, you may carry on now.
I think that I trust this projection on the debt to GDP more than your projection, Leon, to be very honest.
Leon, are you like a Man U fan?
I'm a Man U fan, and John's an Arsenal fan. I cannot understand we are even on the same call. It's not allowed.
Oh well, you know what? I don't watch football that much, but I can see your analogy. It kind of does work.
Mm-hmm.
But yeah, moving on. I feel like we've seen this slide before, but what I wanted to sort of highlight here is the fact that at least government spending, that is, has been on a downward trajectory. National Treasury is now budgeting that expenditure will rise or increase by only 3.5% in 2026, 2027. So this new fiscal year that we're going into. Now that is a huge decrease. And it kind of brings government spending in line with inflation and is a real good sign of fiscal consolidation because over the past 5 years, government expenditure has actually been increasing by an annual average of 5.9%. And last year alone, the increase was sitting around 7%. So this intention of bringing down spending to around 3.5% is a huge step in the right direction. Now, the reason for why government is going to probably bring down spending on government spending, that is for two reasons. Firstly, National Treasury has committed to keeping government spending in line with inflation, especially if you're looking at your consumption spending. So that's spending on goods and services and also the wage bill, which is something we did discuss a little earlier. You're trying to get that back down to be more in line with inflation, and doing that is really going to go a long way in bringing down the whole I guess, overall consolidated government expenditure growth rate. The second, I guess, reason why growth is expected to be muted is because National Treasury has been able to improve the efficiency of government spending by implementing what they call the Targeted and Responsible Savings Initiative. So it's TARS for short. And what the aim of this initiative is to shift funds from ineffective programs to priority projects without actually increasing total spending overall. So far, according to the budget, I think it started in October last year, the initiative was able to save government, I think, or save the fiscus around 12 billion rand. Now that didn't go back into sort of savings where you then reduce your spending overall. What that did was take that 12 billion savings away from the ineffective programs and ineffective grants towards more effective and more priority programs. So you're improving the efficiency of government without increasing the spending overall from government. Now, there are some people who are actually unhappy with this sort of outcome in that spending is being reduced because they would have wanted to see bigger allocations for things like education or bigger allocation for healthcare or more money going into your social payments and social spending. But if you want government to be more disciplined, this is the sort of growth you want to have to see coming out of government spending and showing that government is fulfilling its promise for fiscal discipline, and it should be applauded.
So I agree 100% with that. But then what's interesting is that when it comes to things, take education in particular. I mean, that's a critical thing. And there was talk about connectivity and bringing data to people around South Africa and Africa. And I think it was about the intent is for South Africa to become a hub of, data centers for Africa and so on, if I heard correctly. And I thought to myself, but hang on a second. So correct me if I'm wrong. Again, I'm a novice. Data centers require lots of energy. Okay, energy is not our biggest strength at this moment in time. Online education is now there. It's available. If you can get online education to school in rural areas and start utilizing that, you can immediately make some kind of a dent when it comes to education in the country. Yet we sit with the Starlink impasse. So it seems as though we're overlooking things that could benefit us for the wrong reasons, perhaps. And I suppose it depends on your departure point in terms of it, but that just doesn't make sense to me. The equation's not working.
Yeah, I mean, improving efficiency in how government spends its money and how government actually does its policy implementation and regulation around certain areas, I think is a huge part. For me, and this is why I think it's a good thing that we are seeing spending being curtailed like this, is that it's not about increasing spending. It's about directing the kind of budget that you already have into the right areas for spending. So improve programs that focus on online learning, improve programs that focus on AI and the importance of AI, not only to education, but the future of this country and the future of the world, really, and how important that is going to be going forward. So it's not about spending more, it's spending right. And I think that's what government is trying to do. And hopefully they can find these programs and they can find the regulation sweet spot to get the private sector to participate more in areas where they might be lacking, not only in terms of money, but also in terms of capacity and resources, to get the private sector to participate more in that and get them to be the driver of this growth. And I guess in terms of electricity, definitely not our strongest point. We've improved over time for sure. But if you look at production by Eskom specifically, it has improved, but not at the level where you'd want data centers coming into the country and sort of eating up all that electricity, because that would necessarily leave very little for other consumers to make use of. So hopefully getting in the private sector to produce and into the sort of electricity generation would get the supply improving so that things like data centers and the demand coming from there can make use of more private sector generated electricity and leave some in terms of Eskom generation for your normal consumers, your household consumers, and some of your more industrial consumers in the country.
EBNet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channel by clicking the subscribe button below, share this video with others you think will benefit from it, and give us a thumbs up if you are enjoying the content. That way you help us help you. Thank you from the team at EBNet. For more great content, please visit www.ebnet.co.za.
Yeah. So, okay, with all of that, we're seeing better spending priorities by government, savings from the expenditure side. We're seeing better debt to GDP, better deficit numbers. What does that actually lead to? What you get with that then is these areas of increased discipline results in something that the market hasn't seen in a very long time, and that is a tangible and actually visible decrease in interest expenditure by government. In previous years, your debt servicing costs were constantly going up, and it was even one of the fastest growing areas of government expenditure for a very long time. It got so bad that at some point, government was spending upwards of 1 billion rand a day just servicing its debt obligations. That's a huge amount of money that could have gone into other areas of focus and other areas where you can use to grow the economy or help its citizens. This year, and this is a positive, I guess, outcome, you're seeing that your interest cost to government debt will only increase by, I think, just under 3%. It's sitting at 2.8%. And that's lower than the increase we're seeing in most other areas of government expenditure. Now, this is the benefit of getting inflation down, the benefit of getting your bond yields moving lower, the benefit of being able to control your total expenditure and reduce your debt to GDP ratio. You're seeing that you can now take money away from, instead of spending 1 billion rand a day, and I think at some point it was upwards of almost 22% of the revenue that you take in was going just purely to servicing debt. That's like for every 100 rand you collect, 22 rand goes to just servicing debt. That is unproductive, and that definitely does not help with economic growth, unemployment, poverty alleviation, and reducing inequality. Now we're seeing that slowly going down. Of course, we want to see it to go down to below 20% of your revenue collection, but that is definitely something that will happen over time. And the reason why I think we're probably going to see more of this taking place is because I think government has finally committed to introducing what we call a fiscal anchor. Right. So think of a fiscal anchor as the same thing as, let's say, an inflation targeting, but this time it's by government instead of the Reserve Bank. So government has said that they will introduce a set of, let's say, fiscal rules in the October medium-term budget that will set out or describe parameters under which government expenditure and debt accumulation can take place. So you can either have a ceiling on how much you can grow certain expenditure items, or you can have a ceiling on where your debt levels need to be at. So that kind of fiscal anchor is going to go a long way in reducing the amount of debt that we accumulate. And then obviously then it will tackle how much we need to service that debt in terms of how much we put into it. So that's definitely clearly a move in the right direction. And another area where I think a lot of people didn't realize or need to actually take cognizance of is the fact that government has finally refrained from bailing out SOEs directly. Clearly, Transnet and the post office are in bad shape, but government has not given them any additional funds outright. And they're looking for these types of SOEs to effect their own reforms and do their own reorganization before any funds can be allocated. And funds are not going to be allocated unconditionally now. There's going to be conditional allocations to ensure that the money is spent effectively and in the right areas, to ensure that it's not just a wasted black pit of money going in that we have seen in the past years, where government just bailed out SOEs by injecting cash without any conditions or any expectations coming out of them, at least written expectations, that is.
Was that not similar in terms of municipalities as well?
Yeah, so municipalities are also, there's a hardline being taken on municipalities, but definitely we're seeing more of your national government or central government going into municipalities and taking better control of municipalities, either by telling them what they need to do in terms of their finances or fully taking over these finances and sort of taking over the municipality finances and ensuring that they control it and they can get them into better positions. Now, we see it to be seen how effective that is. And I think Operation Vulindlela is probably going to play a very important role in seeing how these municipalities improve and how they get them into a better footing. Well, of course, I mean, you're talking about what, 270 odd municipalities. It's going to be a lot of work, and it's definitely going to be starting one at a time. Right now, I think the focus has been Joburg. So seeing how that plays out and how you see Joburg, their finances play out is probably going to be sort of a roadmap for how you then tackle other municipalities going forward.
Can you imagine just realistically going into these municipalities, being tasked with that, and you're going into where there's been mismanagement and you're having to tell people this is how you're going to do it? I mean, that's got to be one of the toughest jobs in the world to possibly undertake. There'll be so much politicking, backstabbing, rumors going around, incredibly difficult. It'll take ages to fix.
Yeah, I mean, that's the nature of politics, right? And apparently it is the worst around local municipalities in terms of that kind of politicking taking place. It's going to be a lot of work and you're going to get a lot of pushback. And that's why I'm saying it's a long road ahead. But if you can get one municipality right, you have sort of a roadmap to get the others correct. Each one is obviously different, but it's definitely a step in the right direction.
Okay.
Yeah. So I guess overall, I'd like to, point out that all these positive developments, with all of them taking place, it's actually not surprising that you have your rating agencies and you have your bond market and the currency market. They lacked this year's budget. There's even potential that you will get further credit rating upgrades, particularly from S&P. And you expect that to happen, obviously, after the medium-term budget, when we've seen a fiscal anchor being announced. We could see S&P move us from our current rating, and they did do it last year. If they do it, they could do it again this year, and we could actually see more positive news coming out from your rating agencies if we are able to keep this kind of discipline and this kind of sort of consolidation going into the medium term as I guess the National Treasury has laid out.
So you're telling our viewers they can expect some relief on their bonds next year, that interest rates should continue to be reduced?
Yeah, I mean, if not because of the lower inflation targeting and likely sort of interest rate cuts that could come from the Reserve Bank, purely on a better risk premium on South Africa's bonds, you can get, or South Africa's, debt, government debt, then you can get a better outlook for your rates. Yeah, for sure.
Okay.
Right. So I guess one of the questions you might be asking is, this is all well and good. It's looking good for government finance. It's looking good for credit ratings. But what does the average South Africa get, right? What are the tangible benefits for them coming out of the budget this year? Now, the probably area of focus that most people have when you're a layperson, when it comes to the budget is, am I getting more taxes? Am I going to be taxed some more? What is happening with sort of the tax system? Any more tax announcements? And I think the National Treasury has realized that there's been a significant burden that has been placed on direct taxes and placed on your individuals, your businesses. And you've seen that households have become, it's kind of a little bit unbearable, the amount of taxes that has been tried to be eked out from them. If you look at South Africa and our tax regime, over 80% of our tax that government collects comes from just your personal income tax, your corporate income tax, and your VAT. That's all paid directly by individuals and companies. So that is one of the highest in the world and definitely higher than the OECD average. So not only does this mean that there isn't much more that government can extract from citizens, but it also means that some relief is actually long overdue. And luckily in this budget, we got a little bit of relief coming in from a tax perspective. for households, what we've seen is we are getting relief from the impact of fiscal drag. So what National Treasury has done is they have adjusted the tax bands for inflation so that just because you get a sort of inflation-related increase, you don't just automatically move to the next tax bracket. You get to stay in your current tax bracket, and you also get medical tax credits that are increased in relation inflation related, that is, sorry. I had one of my little brain farts there for a second. So this kind of provides, I think by our calculations, it provides individuals with almost 14 billion rand in tax relief, especially your lower and middle income households. So they will probably get the biggest benefit from sort of the fiscal drag relief that we are finally seeing. And this is the first time that the National Treasury has adjusted our tax brackets since 2023, 2024. So it's been 2 years we've been waiting for this. And in addition,
this is for income earners. What about for the unemployed? I mean, where's the relief in some way for them?
I think for the unemployed, what we're seeing is you're getting higher higher than inflation increases in some of your social grants. So, sorry?
Yeah, the social grants I was about to say. Sorry.
Yeah, so if you look at this graph here, your social grants, I think if you look, for example, the old age grant has increased by 3.7%. We have similar increases for your child grant. And in addition, the minister extended the social relief of distress grant. So that's the COVID grant, where it's been extended for another year up until March 2027, with the amount staying at around 370 Rand. Now, that's unfortunate, but the fact that it's been extended, and one of the sort of announcements that were made in the SONA and in this is that they're extending this, and this is to give government time to finalize a more comprehensive and permanent policy on income support for your working age individuals. So likely expect some announcement happening in the medium-term budget where we're getting a more permanent solution to this SRD grant and getting people who are working age but unemployed getting some sort of support that is permanent and reliable from the government.
I'm not certain what that means, permanent support. I mean, at the end of the day, this slide to me is like the saddest of news. Okay, it's really a terrible slide. I mean, like the numbers have increased so significantly of those who are reliant on this small little grant that it's, I don't know. I don't know how to actually emotionally express it. But also the where you showed the tax slide and you mentioned over 80% comes from effectively companies and the individual. I actually don't have too much of a problem with that. The problem is the delivery. Because outside of that, you're having to pay for everything that you would have expected to get within it, if I could put it that way. So and I suppose I keep on coming back to that in my mind in this budget. It was positive. It was like, ooh, the music started, the music's nice. Okay, let's dance. But are the lights going to go off?
Yeah, I mean, you're definitely right. The fact that our sort of tax burden is sitting in line with a country like Denmark. With Denmark, you can easily see where this money is going. You can see sort of the social programs. You can see on your day-to-day living when you're being taxed, where that money is going. In South Africa, unfortunately, the same isn't observed. We have a problem where I think a colleague of mine once said that for a number of years now, we spoke about how the government is fast running out of money. They do not have any more money to spend. And he told me it's not necessarily that the government is running out of money, it's that the government is not spending its money well. They can always go into the market and get more debt. It's just that debt doesn't, or that money that they do get, doesn't get spent in the right ways, doesn't get put in the right areas, in areas that would encourage employment, job creation, that will encourage people to go out, not only go out and look for jobs, but for there to be jobs to be found, for encouraging the private sector to employ more people, encouraging the private sector to invest more into its businesses, grow their businesses so they can employ more people, encourage the private sector to improve fixed investment, to participate in infrastructure investment, and to actually participate in some of the programs that government has put out. And that requires confidence. It requires business confidence. The business sector needs to be confident that the rug will not be pulled out from under them by government. Changes in any sort of policy, changes in any sort of reform agenda, that will not happen. And they have a strong footing to be then able to feel confident enough to invest in the economy, to invest in their own businesses, employ more people, and get the economy growing again.
So I think that's also what. So look, every little bit adds up in some way in creating an environment. Now, if we're having good earnings coming through now from companies, share prices are going up, people, the shareholders are becoming wealthier. What are they going to do with that money? Are they going to, immediately take it offshore? Are they going to say, hang on, I'm feeling confident about South Africa, so let's build some schools, some factories, some, support some entrepreneurs, new ventures, whatever else. That's all needs to ultimately come down to the fact that their confidence is around the delivery. And that's the gap that I keep on seeing. It's this whole thing, so there's the money's there, but it's just been wasted because there isn't the capacity or the skill to deliver on it. And then that's also affecting internationally. So yes, upgrade, that'll be great, but we need fixed investment from offshore as well. And not just a little bit, we need a lot in order to cater for unemployment and the growth we need.
Yeah, and I mean, that's probably like the last point I wanted to make actually was around what exactly did we not get from this budget, right? I spoke about all these positive things and all these good developments, but unfortunately, the budget kind of leaves me asking, where is the focus on economic growth? Right. So while there are some growth initiatives that we're seeing, and there's always a lot of good talk about things moving in the right direction, government's GDP growth expectations are still quite lackluster, really, if you're looking at it at sort of the grander scheme of things. I mean, if you look at the estimates, the growth rate is forecast to improve only modestly. I mean, you're sitting between 1.5% and 2%, only getting to 2% growth in 2028. That's quite far out. And for South Africa, we need a growth of at least 3% on a sustained basis for government to actually effectively tackle issues around unemployment, issues around poverty, and even issues around inequality. And 3% doesn't seem like it's something that government themselves believe they can achieve, not in the next 3 to 4 years. And the problem is this kind of growth can actually only be achieved if government implements a number of policy initiatives that they are what it feels like. It's not necessarily they haven't really thought about. They know exactly what they need to do. It's just they're a bit more reluctant to do it, and they're slow to move on these initiatives. And I'm talking about things like substantially expanding the use of public-private partnerships, right? So getting the private sector more actively involved in areas where government has had a monopoly, I think could go a really long way in not only improving service delivery, but getting that investment growth that we need to actually get the economy growing faster. Now, like I said earlier, extensive deregulation of the business sector is also needed, right? You want to make it easier for businesses to actually do business. And that in itself will lift confidence. If you just deregulate, a little bit of deregulation, we saw what it did in the energy sector. So once you allow the private sector to participate unencumbered in the energy sector and electricity generation, we saw them flood into that sector. And the same needs to happen in many other sectors and getting them to participate in the economy. Excuse me. So also implementing some serious turnaround strategies for failing municipalities will go a long way. Along with that, prosecutions, getting the people who have been found to be doing wrong in the economy, to be found to be doing wrong in government activities, getting them successfully prosecuted, not just arrested, not just it being known out in the public, but getting them behind bars will go a long way in improving confidence and getting people feeling more comfortable that they can actually participate in this economy and it won't go into corruption activities.
Yeah,
And
well,
doing that,
hallelujah. I mean, I think you're expressing the desire of every South African at the moment, and it's showing in the polling leading up to the municipal elections, and people are starting to feel exactly the same. Come on, guys, we need to now see action take place. But anyway,
yeah,
if you don't mind, I want to quickly go to John because there was positive news around retirement funding
yeah.
within the budget. So
Correct.
can you summarize that for us? And then I want to ask you a question around advice to customers as well.
Sure. Thanks so much. Indeed, that was also fantastic. Perhaps to add on to my comment around it being a phenomenal budget, the reason why I found it phenomenal was because it was the first budget in a very long time that we saw realistic trends in the right direction in terms of that debt to GDP level, in terms of the spending on servicing interest debt from government. So all of those boded really well. We have those tailwinds we've spoken about lots, Leon, around the gold sector, the mining sector, business in general, earnings, and therefore tax takings from corporates. And all of that enabled the minister to have a lot more breathing room and to cancel billions of rands worth of the increases in tax that they had projected that were going to be required. So for the first time in, I think it's 3 years, and you can correct me if I'm wrong, we saw relief for bracket creep in personal income tables. Now that doesn't fix what we've lost in those 2 years, but at least this year your annual increase, if it's around the inflation level, isn't going to increase your effective tax rate. What's also important then is that we saw some relief on the retirement fund side, as you said, Leon. So some allowance for increases over the years in what is tax deductible towards your retirement fund. So that's gone from the 350,000, which has been, I think, since 2017. So that's 9 years, to the 430,000. I think the number is. Yep. That is correct. And then you also saw some changes in de minimis amounts, which means that there isn't a requirement to annuitize on retirement for smaller pockets of money or pots of money, and that's increased to 360,000 Rand, and some changes further on into living annuities. So we also saw some changes in donations tax, capital gains tax, and the like that came through. So all of those are positive. Because it does improve your higher earners' capacity to contribute tax-free into retirement and get recognition for it in the same year. So somebody earning 1 or 2 million, 3 million Rand total income, all of a sudden can contribute basically another 90,000 Rand more into the retirement fund and get tax relief on 45% of that. So, I mean, that's kind of call it 43,000 Rand for free from SARS for putting money into your retirement fund, which is a really nice space to be in.
Okay, so that is the positive. So there definitely were positives, and there's a positive feel about things. There's a positive feel about the country to a degree, but a number of things that are on the edge, like you say, we need to see the prosecutions take place.
Yeah.
We need to see some more cutting in places. So all of that's happened. So with that positivity, with the markets doing so well,
Yep.
John Taylor goes to see one of his pension fund clients tomorrow. He tells them, bring all your money back from offshore, maximize your equity exposure at 75%, and stick it all in gold. Is that your advice?
No, certainly not. Certainly not. So, I mean, I had an exact example of this week. Came across a client that has been sitting, unfortunately, with a large exposure to cash for a very long period of time. And it's that awkward situation where you need to get them back into the market, but now feels like a really difficult time to be transitioning a large portion of money out of the money market and into your kind of growth assets, because the membership still has got long-term kind of liabilities that need to be met. So I would argue that keeping a balanced view still makes a lot of sense. I know, Leon, it's so boring. It's so boring. The thing is, you just have to have a look and say that yes, there've been some interesting earnings announcements in the US. Nvidia came out, and despite the fact that the record profits, record margins, all of these things look amazing, markets punished them because they weren't record enough, as it turns out. There's going to be a lot of wobbles, I think, in the market in the coming months as we kind of adjust that. But the fundamentals around your inflation and your interest rates remain in place, which we would argue should be supportive to some of the tailwinds that we have around equities. So I think it's not certainly not time to dive for the kind of for your defensive assets, but one does need to keep a bit of a realistic mindset to say, as you say, the markets are up 40% over the last 12 months. Do not be surprised when they take a breather and readjust a little bit in the coming months.
Okay, so I'm going to close it off there. Indy, thank you so much for joining us today and taking us through that. It's always fascinating to sit and see the actual stats rather than just talk anecdotally about it. And John, thanks again for the boring advice. Appreciate it. All the best with the football. I don't think that's going to be as heightened as our markets. Please, to our audience, if you enjoyed today's chat, give us a thumbs up and subscribe and comment. I mean, we'd love to read some of your comments that we can respond to, be it immediately or in our next episode. That'll be fantastic. So on that note, thank you so much for joining us to you all. We'll see you again in episode 4. Cheers then.
Thank you.
Thanks. Bye.
At Liberty Corporate Benefits, we believe that better benefits are better for business. That's why our holistic employee benefits give your employees financial security and lifestyle stability, freeing them up to be their best selves at work. With satisfied, engaged employees, productivity shoots up, workplace errors and loss decrease, absenteeism and presenteeism are reduced, and you attract and retain the best and brightest talent. After all, if you take care of your people, they'll take care of your business. Our brilliant basics are the non-negotiables that explain why more companies choose us than any other for employee benefits. Our employee benefits are easy and flexible, personal and relevant, and resource-backed, with investment solutions designed to help your employees retire comfortably. Comprehensive cover that protects your employees and their families, financial literacy initiatives to help your employees make the most of their money, and a range of value-added services for holistic care and support. We make it easy to take care of your people and prove that employee benefits can also be employer benefits. Speak to us about getting the benefit advantage. Liberty Corporate Benefits.